What's up guys, welcome back to the Daily Stock Picks, and in this video we'll be going over the top 3 stocks that you should consider buying right now according to this article by Investors Place. So just keep in mind guys, these are food stocks that are mentioned in this article, and what I'll be doing for you guys is I'll be reading over this article with my beautiful voice, commenting, and we'll be conducting my own quantitative analysis to see whether these 3 food stocks either belong in our dividend portfolio or our value portfolio by using this checklist. More on that later. Make sure that you do stay tuned as we'll be going over the fundamentals of the companies and all. And if you guys feel like being amazing, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it. I know it's quite soon to ask for that, but it would mean the world to me if you guys can do that. Thanks guys. Now let's continue with the video. So 3 hot food stocks to buy to outpace the market. Grab a helping of food stock companies to help power up your portfolio by Faizan Farouk. So the novel CVPD has swallowed nearly every sector. However, there are some industries like food and beverage that have fared better than others, and that's not surprising. But food stocks often don't get the love that they deserve. This is despite these food companies being hot stocks to buy in almost every situation. People can still cut down on any other service, but food is an essential item that will always have a robust demand. Every passing month has brought a rise in demand for the food and beverage industry. According to the National Restaurant Association, sales for food services and drinking places increased for the 3rd straight month. In July, sales fell 19% from the year ago period. Another monthly improvement after sales dropped 22.4% in June and 38.1% in May. So the trend is pretty straightforward. We are firmly on the path to recovery. CVPD cases are dropping all over the country, but God forbid if cases start to rise again, you want to park your capital in stocks that have a safe and secure future. That's why we bring you these 3 hot food stocks to buy. So these are the 3 stocks that we'll be discussing. So the first stock in this company is Texas Roadhouse, ticker symbol TXRH. So the casual dining restaurant is going through a tough time at the moment. Disposable incomes are falling and unemployment numbers are still very high. However, dining restaurants are slowly shrugging off the effects of the CVPD and returning to profitability. That recovery is reflective in the markets as well, as many food stocks have regained a lot of ground lost to the virus. Chief among them, Texas Roadhouse, TXRH stock is up 13.51% in the last month. Quite a healthy uptick considering a demand has not returned to the pre-pandemic levels. Due to the virus, people still prefer to order their food online and have it delivered. But several things are going well for Texas Roadhouse that is helping in its strong performance. It has a clean balance sheet and operations shifts to handle higher to-go orders. The Kentucky-based food joint also has a prominent brand name that is famous among barbecue lovers. But despite all these positives, Texas Roadhouse stock is still trading at a very high multiples. Although that may put you off, I want you to note that shares are still trading at a discount to the 52-week high of $72.49 per share. So you still have a very attractive point of entry to a stock that is a solid long-term growth story. Now let's have a look at the price to earnings ratio of Texas Roadhouse. By entering in the ticker symbol, we can see that the current price to earnings multiple is 73.05, which is definitely higher and expensive when compared to the broader S&P 500 index, which is coming around 29.46. Now, in order for a company to meet my dividend portfolio, it basically has to meet the 4 rules that I've set. These 4 rules, or 4 principles you can say, are based on these 3 books, which I highly recommend checking them out. Now, the first rule number 1 is that the current free cash flows must be positive. So if you want to be investing in companies that are actually generating cash, and this is how we'll find out. whether the company is doing so. And rule number 2 is that we need to make sure that the dividends that are being paid out should not be more than 75% of the current free cash flows. So we want to be making sure that the company is at least retaining 25% of the free cash flows so that it can reinvest back into the business, pay out its shareholders, do the stock appreciation, buy back shares maybe, and pay off its long-term debt. And you never know what the future will entail, so it's always good to hold on to the cash flows by the management so that they can also do some acquisitions if they choose to do so. And rule number 3 is that it needs to have a consistent dividend growth history of at least 5 years. So what do I mean by consistent dividend growth history? So companies make it a priority to increase the dividends year over year, and that's a boon for income investors because they can just get dividends just by owning the stock. But we want to be making sure that it's their main motto, and as a result, rule of thumb I'll be looking for is 5 years or more. The company needs to be increasing its dividends, and if you want to be on the most conservative side, you can consider 10 years as well. And rule number 4 is our buy criteria. So we'll only consider buying the company if the current dividend yield is greater than or equal to the 5-year dividend yield average, which you'll be checking out within a few seconds. Now, let's type in Texas Roadhouse, TXRH, ticker symbol. Once we see this, we can see that the revenue is almost like a straight line, which is really good. And the free cash flows is $75 million. Let's see how much times it has multiplied. 75 double is 150. So you can say that it's doubled one time over the past 10 years, looking at the current cash flow levels. Now, the cash flows are currently positive, but we want to be making sure that it has not paying too much dividends. 102 divided by 159, that equates to around 64% of its current dividends. Cash flows is being paid out as dividends, meaning that the remaining 35% can be reinvested back into the business, which definitely does meet our second rule, but it is a little bit closer to the chest though. Now, looking at this, let's see how consistent Texas Roadhouse has been increasing its dividends. If you were to look at this, we can see that the company has been increasing its dividends since 2012, but just saying, it hasn't been growing its dividends. So as a result, I wouldn't consider this as a part of our dividend portfolio, but we can still consider whether it meets our value portfolio criteria. So in this time, in order for a company to satisfy or be a part of my value portfolio, it needs to meet 5 rules, right? And the rules are as follows. The rule number 1 is the return on invested capital must be greater than or equal to 10%. So 10%, this is basically shows how profitable the company. The higher this percentage is, the more profitable that the company is. And rule number 2 is we need to see whether the company has consistent net cash flows. So we need to be able to project the cash flows to a certain extent into the future by looking at the previous trends of the cash flows. And rule number 3 is that it needs to have a strong balance sheet. So we want to be making sure that the long-term debt, it's basically the money that the company owes to other third parties, can be cleared off within 6 years or less. The lesser the number, the better. And the rule number 4 and rule number 5 are our buy criteria. We only want to be buying the stock when it's at a 20% markdown from its fair price, which we'll be calculating shortly. And sometimes rule number 4 might not be met, but if rule number 5, you can buy it based on rule number 5 as well. If the current price to earnings multiple is lesser than or equal to the 50% of the highest price to earnings ratio over the past 5 years, and it must be lesser than the S&P 500 index as well. Okay. Now let's have a look. Since the price to earnings multiple of Texas Roadhouse is 73.05, we know that the rule number 5 is out of the park, but we can still see if it meets rule number 4, right? For this, what we'll do is we'll type in Texas Roadhouse, TXRH. The return on invested capital, pretty attractive, 18.44%. And the lowest that I could find was around 10.84. So just imagine, guys, even at its lowest or its valley, we can see that the company's return on invested capital is 10%, which is pretty attractive. The cash flows are also consistent, as we can see, but I believe that it's taken a rundown because of the current pandemic situation, but that's all right. Now, looking at the current balance sheet, we can see that it has around $240 million in long-term debt, which it can easily clear off with its current assets, which are nothing but the assets that can be converted into liquid cash within the coming 12 months if the company chooses to do so. So definitely a strong balance sheet in that perspective. Now let's calculate the intrinsic value of the company. So the earnings per share is 0.88 cents, and Texas Roadhouse has been trading somewhere around 12.36 to 74.28 over the past 5 years. And the analysts are estimating that the company can grow around somewhere around 5.95%. So now what we're doing basically is we're multiplying the earnings per share times the analyst estimates at they believe that the earnings per share can grow at for 10 years. And now, in the 10th year, we want to know, if you want to calculate the price at which it might be trading at, we want to be looking at the earnings per share, like the price to earnings ratio. So there is two ways of looking at this. You can either consider the average price to earnings ratio over the past 5 years and consider that might be projected into the future. That's one. Or otherwise, you can multiply the analyst estimates times 2, which will give you 11.9 as the price to earnings ratio. So we want to be considering the most conservative one among these two estimates, which will be going with the analyst estimates price to earnings ratio at the moment. By looking at this, the intrinsic value of the company 10 years from now will be somewhere around $17.62. And the fair price at which we should be buying the stock will be $5.01, considering a 15% year-over-year return for the next coming 10 years. And the right price at which we should consider entering the stock would be at least at a 20% markdown or with the 20% margin of safety, which is $4.01. We know that the stock hasn't been trading at that stage at any time, but just for fun, if you were to look at it from that perspective, even if you consider the average price to earnings ratio, we can see that the intrinsic value is $64.13, which is around the same price right now, meaning that the stock has reached the intrinsic value already. I know that the analyst has advised that it is trading at a 52 below the 52-week high, but you might need to understand that Mr. Market might have priced the stock incorrectly at that particular point in time. That's why it's dropped back to the intrinsic value. So just remember, guys, in the short term, the companies that get the most hype, the most momentum in Wall Street and news articles, and it's like running famous, those are the companies that will be increasing in the short term. But over the long term, like 5 years and 10 years, the company which has strong fundamentals will have a sustainable long-term growth, right? That's for something that you need to keep in mind. As Ben Graham, who's the mentor of Warren Buffett, said, so in the short term, Mr. Market is a voting machine. So whoever is popular gets the price appreciations. But in the long term, it is a weighing machine. The company which has the most weight in terms of its value and fundamentals will perform better. Now, let's have a look at the second company. It's Dunkin' Brands, ticker symbol DNKN. Canton, Mass-based Dunkin' Brands is a holding company for two major American multinational chains, Dunkin' and Baskin-Robbins. The recent quarters were reasonably upbeat, especially considering we are in the middle of a pandemic. Revenues came in at $287.4 million, beating analyst estimates by approximately $11.9 million. Although same-store sales declined for both Baskin-Robbins and Dunkin's Donuts, the situation wasn't as bad as some analysts predicted. You can chalk the excellent performance down to a couple of things. Firstly, Dunkin' decided to remain open at the time when most companies chose to shut her down. Although a risky strategy, it paid off in the end. Meanwhile, a majority of the US-based Baskin-Robbins outlets, 93% to be exact, offered delivery. The crisis acted as a natural tailwind for retail sales, leading to a 250% spike over the year-ago period. The main thing to note here is that Dunkin' management devised and successfully implemented a strategy that helped weather the crisis and come out stronger. That's the kind of astute management that keeps companies profitable, and you would certainly want a slice of that aptitude in your portfolio. Okay, now let's have a look at Dunkin' Donuts and see what its current price to earnings ratio is. So just typing this in, DNKN. It's 28.96, so definitely cheaper by a slight tiny bit when compared to the S&P 500 index, which is around 29.46. Now let's see if Dunkin' Donuts belongs in our dividend portfolio, DNKN. If you were to look at this, we can see that the free cash flows are positive, but it hasn't moved that much. It's more of like a sideline move when compared to the previous company that we looked at. So now looking at the dividends that's being paid out, $124 million divided by 260, that equates to around 47%, or rounded off 50%. So meaning that around 50% of the free cash flows can be reinvested back into the business. That's good, but looking at this, I don't think that the dividends have been increasing, but let's just verify that by considering the going over to Seeking Alpha, DNKN. As suspected, it has been paying out dividends since 2013, but it hasn't been growing its dividends at a consistent pace. As our dividend portfolio criteria is that the dividend needs to be growing for at least 5 years minimum. As a result, it can be a part of our dividend portfolio. But now let's look at it from a value perspective. Okay, DNKN. So the return on invested capital is 10.13, and the lowest that I could see was around 4.91. Okay, now the consistent net cash flows. Yes, there are some consistent cash flows, but it's more of a sideward trend. Now looking at the balance sheet, it has around $3 billion in long-term debt, which if it wants to have that cleared off, it can do so. So let's just consider this as $900 million just for the sake of simplicity. So 3,000. So that's $3 billion is equivalent to 3,000 million minus 848. That's around $2,100 million divided by 260 minus 124, 136. It would take the company around 15 years in order to clear off its long-term debt from its balance sheet. As a result, I wouldn't be considered buying this company from a value perspective due to its current long-term debt. I understand it might be because it's in the restaurant business, but that's the reason for our checklist. We want to be making sure that all of them are met so that we know that we're following as per the sticking to companies with strong fundamentals, right? Now, the third company in this list is McDonald's, ticker symbol MCD. Few stocks are as reliable as McDonald's. It has a Superman-like universal appeal, hence it was unlikely that CVPD would have a massive impact on its results. As it turns out, the effect was even more minimal than initially thought. Same-store sales increased in the fiscal second quarter by a marginal amount. Retail sales finished at approximately $19 billion, beating consensus estimates of $3.47 billion. Drive-through orders represented 90% of its total retail sales for the quarter, an expected development considering CVPD. But what was most heartening was that by the quarter, nearly all of its restaurants were open for business. Looking ahead, the company has outlined an aggressive expansion strategy that includes advertising, value meals, and new locations. In restaurant dining will also make a comeback in the forthcoming quarters. as CVPD recedes into the backdrop. I won't talk valuation here because McDonald's has always traded at higher multiples. You can chalk down to its stable history of returns and rock solid fundamentals. But even though it's expensive, you can't go wrong with McDonald's stock in your portfolio. Now let's see if McDonald's stock belongs in our dividend portfolio. The last time I've checked, I know that it does pay out a dividend, and looking at its price to earnings ratio, it does seems to be a little bit expensive when compared to the S&P 500 index. So we know that this one, the rule number 5 in the value portfolio, is out the door. MCD. So the revenue has been falling, which is not an attractive sign to see, but its free cash flows, $4 billion to 5.728. So it's sub-minimal growth, around less than 5% year-over-year increase if you were to look at this trend. But currently the free cash flows are positive and it's paying out $3.5 billion. So 3.5 divided by 5.728, that equates to around 60% of its free cash flows is being paid out as dividend, meaning that the remaining 40% can be reinvested back into the business. Okay, that's good. Now let's see how consistent McDonald's has been growing its dividends. Looking at its dividend history, we can see it has been paying dividends since 1990, but it has been growing its dividends for the past 11 years at a rate of around 8.72%. Since it definitely does meet our criteria, even for the conservative investors, we can have a look at this further and see whether it's the right time to buy the stock or not. Looking at McDonald's, the current dividend yield is 2.36%, which is definitely lower than the S&P like average dividend yield. As a result, I would be holding off on buying the stock. But just for fun, we know that it has reached around in March 3.25. Let's see how much the cap price would have been appreciated. If you bought the price at that particular point in time, just for owning the stock, you're getting 3.25% returns on your investment year over year just for owning the stock. And in addition to this, if you bought the stock at that particular price target, when did this happen? So this happened somewhere in March 20 of this year. March 20, it was around $148, right? So if you were to divide 211 divided by 148, you would have gotten around 42% return on your investment, knowing that you've bought the company at a really professional blue stock company, and you got 2%, around 3% return in dividends, and as well you would have gotten around 40% return on your investment just within a fraction of few months. So yeah, that is pretty amazing looking at that valuation, guys. Now, because of that particular reason, I would consider McDonald's with its current price of $211.73 as a part of our dividend portfolio, but we want to be wait list, because we want the price to fall at least a few dollars less, or at least ideally the March levels, so that we can enter the stock at that particular time frame. Now, since it doesn't meet the dividend portfolio, we can definitely consider and see if it meets our value portfolio for this. Now, looking at this, we just need to type in McDonald's. So the return on invested capital is 23.73, which is definitely a positive number. And looking at that, we can see the minimum over the past 10 years was around 15.35, which is just really amazing for a company of this size. The thing that I am concerned about is that the revenues have been falling over the past 10 years trend, but the free cash flows has been increasing. If you were to look at this, the free cash flows are okay, and we can estimate it to a particular extent. Just imagine around less than 5% growth on the free cash flows for the next 10 years. So it's not a growth company, it's basically a blue chip stock, which has already matured in a way. Now, looking at the balance sheet, it has around $38.76 billion in its long-term debt, which it can clear off around $6.6 billion, so 38.76 divided minus 6.609, that equates to around $32 billion in its long-term debt. So 5.728 minus 3.582, $2 billion. So it would take the company around 16 years in order to clear off its total long-term debt. As a result, since its long-term debt is pretty heavy, we can't consider it as a part of our value portfolio by either rule number 4 or our rule number 5, because the first 3 criteria haven't met in order for us to do the further calculations. So as a result, out of all these 3 companies, what I believe is that McDonald's is the right company to buy if you want to consider it as from a dividend income investing perspective. But right now, I would hold off on buying it and add it to your watch list to see if the price does fall down and comes to the current dividend yield of at least 2.57% or more. Then you should be considered buying the stock at a conservative rate. Okay. Now let me guys know if you think that there are other methods of evaluating the business apart from these 2 techniques that I meticulously follow. Make sure that you put them down in the comments down below. Now the closing remarks. So disclosure: on the date of publication, Faisal Farouk did not have either directly or indirectly any positions in the securities mentioned in this article. Faisal Farouk is a contributing author for investorplace.com and numerous other financial sites. Faisal has several years of experience in analyzing the stock market and was a former data journalist at S&P Global Market Intelligence. His passion is to help the average investor make more informed decisions regarding their portfolio. All right, had a really fun time reading the article and considering his perspectives. That's really good. And if you guys have stayed around till this part of the video, I really appreciated my hardcore gang. Now, full disclosure, I do want to mention that this video is for your education and entertainment purposes only. Please do your research before investing in these stocks, because there is no guarantee that you can earn money by using the techniques and ideas mentioned in this video. This is not a financial advice. Please consult your financial or tax professional prior to making an investment in these companies. And if you guys want to stay tuned with all the videos that we upload on this channel, because we upload 5 days a week from Monday to Friday, make sure that you turn the subscribe button and turn on the bell notification icon so that you can get notified as soon as we post the new videos. And catch you in the next video. Peace.